Hi. So, to begin with, let's start with an understanding of goods and services tax, which is again a key component in your Singapore tax paper. Now, the concept of GST is similar in almost all countries across the world. Some countries call it GST, some countries call it VAT. And the point, the starting point for this discussion should be the fact that GST is an indirect tax. Now, there are two types of taxes, and I'm sure you are aware of those. There is A, direct tax, and B, indirect tax. What are direct taxes? Direct taxes are those in case of which the impact and incidence of tax is on the same person. So, if I am the one who is earning the income, then I am the one who is responsible for payment of tax. And indirect tax is a situation where the impact is on one person, but the incidence is on another individual. Now, let's take an example. When you go and you purchase a packet of chips, that packet of chips is worth 10 rupees, and that 10 rupees includes the amount of GST. What the seller does is the seller charges 10 rupees to you. Out of that, 8 rupees he keeps himself as his revenue, and the remaining 2 rupees he goes and deposits that with the government authorities. So he is only collecting the tax and depositing that with the government, but the ultimate burden of the tax is falling on you, the consumer. The seller is only acting as a collection agent. So the impact, the burden of tax is on the consumer, but the incidence, the levy, the point of taxation is the seller. This type of tax is known as indirect tax. Now, indirect taxes, again, there are multiple varieties, like there is VAT, there is simple sales tax, there is customs duty also, which by the way is an example of indirect tax. Now, in case of GST or VAT, there are certain defining features that you should be aware of. Say, for example, there is a person, say, for example, there is Satyamed, and Satyamed sells goods worth 10,000. ठीक है, sale value 10,000, and on that he levies 20% GST. Okay, Satyamed levies 20% GST on this into 20%, and the total price is how much? The total price is 12,000. Now, Ashna purchases goods from Satyamed. This is her raw material. So, for Ashna, overall payment is 12,000, and purchase base value is 10,000, and GST is 2,000. Can I say that this is tax on purchase for Ashna? On the purchase that she made, she had to shell out a tax of 2,000. Now, she processes the raw material and makes finished goods. Okay. Now, the base sale value of these finished goods is, say, 25,000, and rate of GST is 20%. So the total price charged to her customer is 25,000 plus 20% of 25,000, which is 30,000. Now you see, she is collecting 5,000 GST from her customer and paying it to the government. Now, at the time of sale, there was a certain amount of GST that was levied, which was 5,000, and she deposited this 5,000 with the government. And when she purchased goods from her supplier, that is Satyamed, she had paid tax on the 2,000. She had paid 2,000 worth of tax on the purchase price. Now, if you observe, the raw material is worth 10,000. Then there are some processes that happen, internal processing, which leads to value addition. This brings the total to 25,000. Now, she's paying tax on 25,000, and on this raw material, she has already paid a tax of 2,000. So this 10,000 is entering into production process, and on the total amount of 25,000, a certain amount of tax is being levied. So on one hand, you are levying tax on the sale value of 25,000, and on the raw material of 10,000, already tax had been levied. So don't you think there is tax being levied on the same item again and again? On this 10,000, there was tax levied once 2,000, then 10,000 plus 15,000, total value of the final product is 25,000. On that again, tax is being levied. So tax is levied on 10,000 twice. So this situation, where tax is levied on the same material, on the same item again and again, is known as, what is it called? This is called as cascading effect of tax, where tax is levied on the same item again and again. Now, Ashna, the seller, might get completely discouraged because she is paying tax on the same material twice, which is increasing the overall cash outflow from her end. So, Ashna might not be incentivized enough to grow her business, to make sale, because she ends up believing now that on the same material you are levying tax twice. So, the approach to taxation, because of this issue, so many sellers, so many traders raised this particular problem, because of which the approach to taxation ultimately had to change, where now tax is levied only on value added. So in this case, if you observe, the value added is 25,000 minus 10,000, that is 15,000. Value on the amount of value added, that is 15,000. The principle has now changed, and now you levy tax only on the amount of value added, not on, while tax is levied and collected on the amount of 25,000, the ultimate tax payment that Ashna will have to do, not levied. Tax is paid only on the amount of value added. So if value added is 15% and tax rate 15,000 and tax rate is 20%, then the amount of tax payable will be 20% of 15,000, that is 3,000. So 3,000 worth of tax is levied, which if you think about it, it's 25,000 into 20%, that is tax on sale, minus 10,000 into 20%, that is tax paid on purchases. So 5,000 minus 2,000, that is ultimately an amount of 3,000 is paid by Ashna to the government authorities. Now, what if you observe, what has happened is the tax paid at the earlier stage, that is tax that she paid on purchase, has been taken as a deduction, and only the net amount has been paid. So this tax which you pay only on the amount of value added is called value added tax. Now, in the United Kingdom, they call it value added tax. In India, we call it goods and services tax, GST. And in Singapore also, it is called by the same name, that is goods and services tax. The fact that, you can subtract the amount of tax paid on input from the tax payable on output, this phenomena is known as input tax credit. Okay. The tax paid on purchases, which is allowed to be adjusted while calculating tax payable at the time of sale, is called input tax credit, and which is, of course, which goes with the abbreviation ITC. And input tax credit is a term that we'll be running into very, very frequently. Now have a look at this goods and services tax. GST was introduced in Singapore with effect from 1st of April. Of course, in India, it came in much later. Back then, the standard rate of GST was 3%. This rate was increased to 4% in 2003, 5% in 2004, and from 1st of Jan 2024, it stands at 9%. GST is a tax on domestic consumption. It is paid whenever goods and services are bought by consumers from GST registered businesses, or when goods are imported into Singapore. So, for GST to be levied on you, you have to be a GST registered business, and uh, if you are not registered, and there are of course certain threshold limits for registration, unless you are registered, you will not be expected to pay the GST. GST, the scope of GST in Singapore is based on the New Zealand model. Essentially, GST is levied on goods and services supplied in Singapore by any taxable person in the course or furtherance of a business. So, if I am a trader and my trader or I am a service provider and my overall turnover exceeds a particular threshold, then I get classified as a taxable person, a person on whom tax can be levied, and that person is supposed to pay tax on goods and services supplied in Singapore and goods imported into Singapore by any person. Now you see the difference here. Here they have mentioned it has to be a taxable person. So if you are someone who is selling goods and services within Singapore itself, then your turnover has to cross a particular threshold limit to be considered as liable for GST. But if you are an importer of goods into Singapore, then regardless of whatever your turnover is, you have to pay tax. Tax is paid whenever money is spent on goods or services, as well as on the importation of goods into Singapore. GST for goods and services is collected by GST registered businesses, while import GST is collected by Singapore Customs at the point of importation. What you need to understand is GST, there is a misnomer. People say that GST is levied, but GST is not levied. GST is levied by the government, but you as a seller, you cannot charge GST. You are collecting GST from the customer and depositing that with the government. If you are an importer, then on the import of any goods in Singapore, goods or services, GST has to be paid by the purchaser. Now, usually the liability for payment of GST falls with the supplier. Okay. Liability for payment of GST is on the seller or the supplier. But if you are someone who has imported goods slash services in Singapore, then you as the purchaser are supposed to pay GST to Singapore Customs. Singapore Customs only will collect the amount of GST from you, and they will not release the goods to your custody unless you have paid the amount of GST. Output tax is tax that is charged and collected by GST registered businesses from their customers and is paid to IRAS. Input tax is tax paid on purchases. The difference is the amount that you pay to the government. Now, if tax on sale is greater than tax on purchase, then you have to pay tax. And on the other hand, if the amount of tax on sale is less than the amount of tax on purchase, then you can claim a recovery or refund from the comptroller of GST. In certain circumstances, the customer is responsible for paying the output tax to IRAS. In this case, no GST is charged or collected by the GST registered business that makes the sale. Instead, it is the GST registered customer who has to self account to IRAS for the GST chargeable as output tax. Customer accounting currently applies to the local sale of mobile phone, memory card, and off-the-shelf software exceeding $10,000 in value to a GST registered customer for his business purpose. Now, please understand that usually the liability for payment of GST falls on the supplier. This is known as forward charge. Okay, but there is a situation which is also called as reverse charge. Okay, the purchaser is supposed to pay. Now, what is the second situation that we saw here? The second situation that we saw was customer is responsible for paying the output tax to IRAS uh, instead of the seller. GST registered business, GST registered customer who has to account to IRAS for GST chargeable as output tax. Customer accounting applies to local sale of mobile phone, memory card, and off-the-shelf software exceeding 10,000 in value to a GST registered customer for his business purpose. So, if a seller sells any of the below items, for a value greater than 10,000 SGP, then the seller is not required to pay GST to the government, but the buyer is. Seller is not supposed to pay GST to the government, but the buyer is supposed to pay GST to the government authorities. Now, this is a reverse situation. Usually, the seller is supposed to collect GST and pay to the government, but in rare circumstances, the responsibility falls on the customer. Now, this is sometimes, see, these are certain items which are, relatively sensitive in nature, or these are items, which are more dangerous, bolo, yeah, they should be scrutinized more in the hands of the buyer, not so much in the hands of the seller, which is why uh, GST is levied on the buyer, not on the seller. This way, the seller, this way the person, say for example, who is buying mobile phones or someone who is buying off-the-shelf software, the government keeps a detailed record of these kind of transactions. Now, you have to understand that these are exceptional cases or rare cases. This can be asked to you in the form of a multiple choice question. But remember one thing, when the customer pays GST to the government, then there is a different principle known as for the input tax credit. We'll see how that part works. Now, understand that types of supplies, whenever a seller makes a supply, the supply is of two types. One is a taxable supply and the other is exempt supply. Exempt supply is, these are goods and services exempt from GST. That is no GST applicable. On the other hand, when I use the word taxable supply, these taxable supplies are those goods and services on which GST is applicable. Now, please understand that goods and services on which GST is applicable, these could be standard rated. Okay. Standard rated means in different countries, there are different standard rates. Like in India, there is an 18% rate. In UK, there is a 20% rate. In Singapore, there are, again, other specific rates, as well as there is a zero rated supply. Okay. Zero rated supply means, see, GST is applicable, but rate is zero. Exempt supply means GST is not applicable. There's a difference, and this difference will become all the more clear when we understand and try to get into the depth of when is input tax credit available and what is the quantum of input tax credit that is available. In case of taxable supply, there are two types of taxable supply: standard rated, which is according to the rates prevailing at that point in time, and zero rated supply. Now, zero rated supply is usually observed in case of export of goods. The government, in order to promote export of goods, brings the rate to zero. See, when the term used is zero rated supply, what it means is that GST is applicable, just that the rate of tax is zero. But in case of exempt supplies, what that means is GST only is not applicable. Standard rate is 9%. To understand further how GST works and how it is collected at every stage of the production and distribution chain, let us take a look at the table below. We have seen it through our example how GST is levied at each stage and how tax paid at the previous stage can be allowed to be deducted from the tax to be paid at the later stage. For simplicity, we assume that the supplier has no input tax claim but only collects output tax of 45. See, they were looking at this example: supplier, manufacturer, retailer, and what will be the amount of GST payable. Okay, now let's have a look at the some basic concepts of GST. All of these are going to play a very significant role in the multiple choice questions and in the constructed response questions also. The following key concepts are crucial for GST. Definition of supply. See, goods and services tax. Tax is levied on the transaction of supply. But that means we first of all have to define supply. Satyamay, gifting a wallet or gifting a phone to Ashna, is that supply or is it a gift? Is gift covered under supply? For that, we'll have to look at the specific definition of supply. Apart from importation of goods, which automatically triggers the imposition of GST, GST is chargeable in Singapore when all of the following conditions are met. There are four conditions. Taxable supply of goods and service occurs. Taxable supply is made in Singapore. The supply is made by a taxable person, and the supply is made in the course or furtherance of any business carried out by a taxable person. First of all, see, they are constantly emphasizing on the word taxable. What does it mean? There are exempt supplies also, supplies on which there is no GST applicable. So to be covered under the ambit of GST, it should not be covered, it should not be an exempt supply. Only if a taxable supply is made in Singapore will it attract GST. If a supply takes place outside Singapore, then GST may not be applicable. Hence, it is important that it should be made by a taxable person, it should be made in Singapore, it should be in the course of furtherance of business carried out by the individual. So, if I am just gifting you something on your birthday, then it is not in the course of furtherance of business, and hence GST will not be applicable. Then the person must be a taxable person, meaning that the person must be registered for GST purposes in Singapore. If he is not registered, he has absolutely no right to collect output tax for the authorities. Now, this needs a little discussion. When a person gets registered for GST, the government gives him a GST registration number, which is a unique identification number associated exclusively with that person. Now, what you need to keep in mind is that you can collect GST on sale only if you have a GST registration number. If you don't have a GST registration number, you cannot collect, which means that number is a permission given to you by the government for collecting GST from customer. If you are not registered under GST, then you cannot collect any tax from the customer, and any such collection actually might land you behind bars. Okay, now it has to be a taxable supply by a taxable person in Singapore of taxable goods and services. Now the supply must pass the business test. That is, it has to be in the course of furtherance of a business. It cannot be for non-business purposes, or it cannot be for private use. Provision of fringe benefits to employees involves the making of supply, and the company may have to account for a deemed output tax. Say, for example, the company is providing me with gardener services. Okay. Now, if the company is providing me with gardener services who comes and does gardening at my company owned accommodation where I am staying, now otherwise I would have to avail the gardening service from an external third party. Now my employer is providing it to me as a part of my salary package. So that is also for furtherance of business. It will invite GST. But gifting a bag to someone on his or her birthday is not for the furtherance of business, does not invite GST. If it is for private purpose, it does not invite GST. Under GST Act, a supply is defined to include all forms of supply, but not anything done otherwise than for a consideration. This means that a supply includes all transactions that result in goods and services being provided, and also at a consideration, which means there has to be a commercial substance to the transaction. If you are gifting, if you are giving free samples, then it will not involve GST. Hence, there would be no supply made if a service is provided free of charge. Now, again, here, if you look at this paragraph, this is a good, you know, question when it comes to MCQs. Why? Because they will give you that a company has given 100 free samples. Will there be GST? It is necessary that when it is done in the furtherance of business, it has to invite consideration. The customer should pay you something. If you are simply giving out free samples, that does not come under the definition of supply. However, there are situations where a supply is deemed to have been made, notwithstanding that it is done without consideration or outside the normal course of business. This is provided for in the GST Act, which deems a number of situations to comprise a supply of goods or services, though no consideration is actually provided. Now, what are those circumstances where a transaction will be deemed to be supply even though there is no consideration in exchange? Business gifts exceeding $200 in value, or if the gift is one of a series of three or more gifts made to the same person over a period of 3 months. Disposal of so business gifts exceeding $200 in value, or if the gift is one of a series of three or more gifts made to the same person over a period of 3 months, which means if a business gifts goods to someone whose value is more than 200, it will invite GST. If you give three consecutive gifts to a person over a period of 3 months, then also it will invite GST. Disposal of goods forming part of the business assets. Business assets put to private use. I am a sole trader. I have a car that was being used for business, but now I am using it for my private purposes. The business asset put to private use is also covered. And provisions of certain fringe benefits to employees. What are fringe benefits? Fringe benefits are basically perquisites or certain benefits which are payments which are not in cash. Say, for example, in the house that I am staying in, my employer has provided me with a microwave. That is a fringe benefit, and provision of fringe benefit to employees is also covered. Consideration can be in monetary or non-monetary terms, doesn't have to be only in monetary terms. A fruit seller is making a supply where he sells his pears for $0.8 each. The point 0.8 is the monetary consideration for each pear that he sells. He's also making a supply when he exchanges his pears for another person's apples. In case of barter also, although there is no monetary consideration, there is a non-monetary consideration which can be converted into monetary terms, and hence there will be GST. And don't worry, I'll be giving you handmade notes on this. So with every topic that I do, you will keep on getting handmade notes. Now, if I'm talking about types of supply, under GST purposes, there are taxable supplies and exempt supplies. And in taxable supplies, you have standard rated, that is supplies on which the rate of tax is 9%, and those supplies like exports on which the rate of tax is 0%. There are also some supplies on uh, which are exempt, which are not covered under GST. As in, and of course, GST is not applicable as per law. Sorry, I made a small mistake. I should say GST is not applicable. And then there are out of scope activities. That is, they don't come under the ambit of GST at all in the first place. Now, I want you to read this. While I have explained zero rated supplies and standard rated supplies, you should learn the list of activities that are covered under out of scope supplies. There are transactions whereby GST is not applicable at all. That is, there is no output tax chargeable or input tax claimable. There is a list of five items which are out of the scope of GST, and which are these. The place of supply is outside Singapore, that is third country sale. Supply is made by a non-taxable person. So if I am not registered for GST purposes, then I am a non-taxable person. Supply is not made in the course of furtherance of business, that is, it is a private transaction. If the entire business is transferred as a going concern, which means I had a running business and I transferred my entire business to you in its working condition without halting it, without stopping it, that comes under transfer of business as a going concern, and wages and salaries paid to staff. Now, again, in your list of multiple choice questions, they could very well ask you this. They'll give you a list of activities, and the question could be, identify which of these are out of scope, or identify which of these are not outside the scope of GST. So you will need to have a very strong grip. You will have to learn all of these. Then, exempt supplies. Traders making exempt supplies are not required to charge GST on their inputs. As these goods are not subject to GST, the supplier is also not entitled to recover any input tax. Now, I want you to understand how GST law actually functions. See, saying that GST is not applicable means they are outside the scope of GST. Saying that GST is exempt means you are not supposed to collect GST. These are supplies. These are within the scope of GST, but we are not charging any GST. There is no GST. And what are zero rated supplies? Zero rated supplies are those where GST is applicable. They are well within the scope of GST, just that the rate of GST is zero. That is the difference between a zero rated supply, an exempt supply, and supplies which are outside the scope of GST. You don't pay tax on any of these, please remember. But Also keep in mind the fact that the reasons are different. In zero rated, GST is applicable, but the rate is zero. In exempt supplies, GST is not applicable, as in it is under the ambit of GST, but it is GST is not levied on these items. And out of scope activities means it doesn't fall under the purview of GST in the first place. Now, the place of supply of goods and services is again a very important point, and that will help you to determine whether GST is supposed to be levied on that particular item. Now, this will form the next part of our discussion, place of supply.